Okay, now we do a panel discussion, our little closing panel. We make it nice and short. And then we take a group photo with all of you coming onto the stage, okay? So if you want to be on the photo, don't run away now. We have Alois Flatz of Generation Investment Management. This is your chair, Alois. Chair. We have in the middle, the future unicorn, Philipp Pausder of Thermondo. We have another future unicorn, Solarkiosk, Andreas Spiess, and Bruce Huber of Alexa Capital. Generation investment, investors, startup, and I call him a service provider, but you are basically helping startups raise big rounds of money. We talk about that in a minute. I want to ask you, Alois, can you explain to me and to the audience the idea of unit economics for a company, how you measure them and why they are important when you look at startups?
Okay, thank you and good afternoon. Last session, so and we start with a definition, or we finish with a definition. Unit economics. Unit economics is a concept to measure direct revenues and cost of associated with a business model expressed on a per unit basis. And on a per unit basis, that can be, if you have the typical hardware piece, or let's say a bottle that you drink, so what are the costs associated, direct costs and revenues on a hardware piece, or if it's more on the internet side, then it's the unit is the user usually, and you know, then usually we talk about customer lifetime value. So what are the revenues that you can generate over a lifetime with a revenue with a user, and you associate that or link that to the cost to win a contract or a user, so customer acquisition cost usually.
Philipp, how are the unit economics at Thermondo, and how important is it for you to work on your unit economics to basically make more money in the end? How much are you?
Yeah, so well, unit economics are critical. They are the basis for any profitability. So like Alois explained, after all direct costs, including customer acquisition costs, in our example, it is marketing and sales costs. So after all the salaries you pay to your salespeople, the bonuses for your salespeople, and the marketing costs, are you then still profitable? We call that gross margin 3 in our own definition, and we are. So on a unit level, we are gross margin 3 profitable. We look at unit economics across the various regions or states in Germany. So we are actually an EBITDA profitable company in Bavaria. And in Baden-Württemberg, and in the north we are losing money. So if you wanted to be profitable and a smaller company, we could actually be that. And so I guess other companies would do that on a pan-European level, but for us, an individual state is quite a large market. And then, obviously in our case, so that's the first sale, right? So that's old heating system out, new heating system in. But the real magic of our company is then the customer lifetime value, so the second to 10th, 15th purchase that we trigger. And we don't know these even yet. We know 2 of them. We know maintenance and unplanned maintenance, or alternatively, you go for the leasing. And so we are kind of like able to assess unit economics for those. But for all the stuff that's coming up in the future, we don't even know. And thus, we don't know our ability, what kind of customer acquisition costs we could actually afford.
Andreas, how do you define impact, and why is it so important for you to measure impact and to create impact? Give us a little impact education.
Yeah, I love doing that, although I also like to talk about unit economics.
Okay, afterwards.
Because it really goes hand in hand. Impact is very simple. So we are impact investors ourselves. Vested in various companies all over Africa, and it's a social, environmental, and economical impact that we are desiring, and it needs to be measurable. It needs to be triple bottom line, so it means just social doesn't work, just economical doesn't work. It has to be the three of them together. And why am I also interested in talking about unique economics? It's a little bit the same that Philipp says. You know, I have one of my my affiliate companies which is even EBIT positive, but that's the one that has the least impact. So what are we going to do about it? Just separate the two and sell one off, or make an amazing IPO or whatever, or keeping them together to scale our impact. And we have decided for the latter, and that's an ongoing discussion with our investors. And that's why we only are targeting those investors who really understand our game on the longest game.
Bruce, you are helping startups raise incredible amounts of money. You did a good job, I believe, for Unicos. Can you explain a little bit how did you sell Unicos to the investors? What was important for the investors in terms of the performance of the company, and how basically, how do you market a good startup to investors?
It's a really relevant question, and I think very relevant to this audience and the Ecosummit event. Unicos is a strategic, a strategic platform and a strategic market. One of the things that we're seeing, and I think as I reflect on these past 2 days and the Ecosummit event, which is a fantastic way of bringing the entrepreneurs and the technology to primarily the corporates and the capital, we're in a phase of the market which is all about strategic positioning, and the capital is flowing to strategically well-positioned companies. So it was all about strategic alignment. And at this phase, and we should step back and look at the big picture, we are still in the early days of the energy transition. We're still in the early days of seeing the real traction in technology-enabled services that are able to scale in a capital-efficient way, because the capital that has flowed into this sector has been very capital-intensive. The money that's flowed has been very capital-intensive business models. The geometric growth rates that we expect to see over the coming years are about strategically positioned companies that are able to be capital efficient in their growth. And we wouldn't be here today if we didn't have the benefit and Jan, with your organization, bringing together the corporate pockets of capital that are making this industry happen today. But I think one of the big messages that we all need to take away is that this sector needs to institutionalize. We need to see more than the corporate capital here. We need to see the capital that provides the lease and project financing that underpins the behind-the-meter and distributed generation capital. That equipment needs to be financed. When these companies who have exceptional, and many of you here today have exceptional growth opportunities, the accelerator of your growth will be that ability to provide a fully financed energy as a service, fully financed technology. And so the institutional capital is a big part of that, and bringing the institutional capital in alongside the corporate capital that's helping to facilitate where the sector is today is the critical next step.
Alois, I want to ask you about fund performance. Is it actually possible to make money as an investor in clean tech in the long term? What do you think?
Yes.
What do you hope?
I don't. There are no hopes. That's possible if you do it the right way.
Yeah. What is the right way?
I would say a lot. A lot depends, of course, also on the right timing, and on the vintages, and also, get the right timing, get the right stages of a company. And I think what's important is that if you have an investor, independent of being an early stage or late stage investor, or if it's corporate or financial investor, stick to the strategy that someone wants to go, decided to go, and to focus on those areas that someone understands. And I think then it's much easier. Of course, you have always. I think the biggest risk that historically that we have seen were dramatic changes in regulatory framework. When demand or a complete market breaks away, you build a company and then a market or breaks away. I think this is probably the biggest risk, and this is, I think, the dependency quite often on the regulatory framework, on incentive schemes, which can make it very difficult to build a company. For that reason, of course, we can see a tendency now that especially financial investors focus more strongly on companies that can scale faster, more asset-light a company. On the other side, there is a strong need in the market to fund those companies that are a bit asset heavier, but still capital efficient. And I think that what will be important is to find the right combination that with new and good financing or asset-backed financing is used to help companies with, let's say, a bit of a heavier asset base to grow. I think one example was, it's not a European one, but was SolarCity those days, you know, where they find a good combination of providing a service, finding the right financing, you know, the way that Bruce just explained it. And you constantly need to adapt that also to the regulatory framework and to needs. And probably that will be something that your company, Philipp, will also apply one day, you know, that you can probably offer heating systems, and you find a way to do it, or you do it already, you know, asset-backed financing in the background, provide leasing. These are these kind of ways that you can probably reduce the longer-term risk of asset-heavier investments in companies.
And just maybe to add to that, yes, we do that already. Up to 20% of our customers choose the leasing option. So that's typically 10-year contracts. It's backed with KfW funds, so actually debt, cheapest money in the world, 0% coupon. And building that kind of product is a company in itself, you know, to be able to, on a semi-industrialized way, to get kind of approved projects, and it's a lot of projects, to be eligible for KfW funds, and then have that money actually in our subsidiary, and we are fully backing that. That's a pretty complex product in itself. But I just want to, because I think I'm with Thermondo, we are like able to compare the supposedly the two worlds, you know, the digital and the clean tech world, and we are dealing with investors on both sides. Also in our shareholder body, we have both types of investors. And interestingly, the more mature a company gets, the less that matters. You know, so in early stage and on the VC space, that matters a lot, because obviously most investors, if not all investors, like to invest in things that they know, that they've seen somewhere, that they obviously are able to follow. Well, now when you really talk to late-stage investors, they really don't care. They care about business, they care about market size, they care about unit economics, they care about growth rates, and they don't even think in whether this is digital, clean tech, asset intense, yes, no. So they do care about burn and capital requirements, but it doesn't matter what segment it is for them. And I do think that on the clean tech side, because most of us follow a certain industrial logic, and I think that's the common denominator. We all follow the logic of the opportunities coming from the energy transition, and whether it's here or there, that it all kind of falls in place. And now we are in a market where a lot of the capital is coming from those that we actually disrupt, if you think about it. So, and that's a bit of an odd situation if you think about it. It's like if IBM would have given money to Facebook, or you know, so it's a special situation, let's say. But make no mistake, yesterday you talked about unicorns. If you're really serious about that, you're going to need a lot of capital. And then basically your option is, are you serious about becoming a large company? Then you need a lot of capital. You know, it's if you take even supposedly asset-light companies like a Delivery Hero here in Berlin, which is probably going to IPO anywhere between 3 to 6 billion this year. They raised 1.3 billion. Because at one point you're going to buy companies also.
I ask you one of my favorite questions, okay? Because Thermondo is really famous for still operating only in Germany, and you believe that Germany is a really big and important market. Why are you only active in Germany so far, and when do you think you will enter your second market? And how much chances do you give to potential competitors by copying you in another country, by not going in other countries?
Mm-hmm. First of all, we get copied in Germany, so they're direct copycats of us here. But what we care about is where can we grow? And from a company building point of view, you want to invest your next hour, your next euro, as efficient as possible. And since we're also a brand game driven by a special customer experience that we give to customers or provide to customers, brand matters. And we have a certain brand here, obviously not a very well known yet on the general scheme of things, but we do have a bit of brand equity in this country. And then the market is large enough, like a late stage investor typically would not ask that question. On the contrary, they would actually say, please stay in Germany. It's really large. It's so large. Your market, Philipp, is very large. Many people think they operate in large markets, but your market really is large. It's a humongous market we're in. And so that's how we tackle that question. In the end, it is also just a question of capital, because if you have covered it end to end, you're really confident on your processes, and you have really understood it, then it's just a question of, do I have enough capital to do it again somewhere else? But so far, I think we have taken the right decision on being focused in Germany, and we will do that at least for another 12 months.
How many employees do you have now?
I checked it this morning, 290.
Wow. And you, Andreas, how many employees?
More than 500.
More than 500?
Yeah.
And you actually are active in many countries.
Yeah.
Isn't it quite complex to operate in so many African countries at the same time, being a guy in Berlin?
Yeah,
where there's lots of people, of course.
It's a big challenge, and it's quite interesting. I'm nodding in consent with what you're saying, because we come from the opposite side. So we scaled very broad instead of deep. And now we have decided to take a step back, and with the next round, we'll really scale deep in 3 top priority countries which we have identified.
Which are they?
Rwanda, Tanzania, and Kenya.
Okay.
I think it's a really interesting value. You asked make a profit as a clean tech investor. I would like to also ask the question, make a profit as a clean tech startup entrepreneur. That's, I think, something we share. And yes, we can grow. I think you can grow now in other countries. The question is, who will finance the growth, and what will you personally pay for it, and how will you dilute with it? And I think it's very, very smart what you said when you said we have to be more intelligent in regards how we structure the finance, and that we do a lot of asset financing in a different way, and that is in our case very much driven by debt capital, which will not dilute us, which will divest or which will decrease the risk, but still allow very ambitious companies with a unique business model to scale exponentially. And I'm very happy to hear that you're relaxed, but we're not relaxed at all, because, again, see it from an impact investor's point of view, we really have to solve a problem here. And that's the problem of Africa, with doubling the population by 2050, and the vast majority of which have no access to electricity. And we simply do not want them to become refugees, because then that's also the end of Europe. So there's a lot at stake here. So we need a lot of money, we need a lot of investment, and we need it on a long-term basis, because, again, we can be profitable by the end of the year. We just shut down all our retail-oriented companies, focus on our very, very unique technology, sell that to large corporates, NGOs, and governments, and then we make everybody happy. But we will not have achieved our mission, which is scalable, maximal impact.
I wanted to, if I could, pick up on something Philipp said, and I was very, very encouraged by a discussion we had before we came on stage, which was the reference to the amount of debt capital, Philipp, they're already bringing into your business. And you know, what's interesting, and I guess we're saying, is there is no shortage of capital out there. I mean, in fact, we're in a world which has an excess of capital to be deployed. Our challenge is getting that directed into this sector. So as the earlier companies can embrace credit, and when they embrace credit, the equity investors actually look at it and say, "Gosh, you brought the banks in here, or you brought the credit institutions. You must be investable with a lower return expectation than somebody who hasn't yet brought credit in." So it's an important lesson as folks build their businesses, to think about how to tap into credit, not just equity. I think the second thing is, again, back to the fact that there's a massive amount of capital out there. the big challenge the sector has, and we're beginning to move through that tipping point and seeing that in a number of cases, we're getting to sort of more platform businesses with more homogeneous offerings, which can be leasable or financeable. And that's the tipping point that this sector needs, because we need to move from, we've been through a couple of generations of just financing upstream generation and upstream assets, and this is harder to do. The market is now beginning, and I've been so encouraged by all the company presentations I've seen over the last 2 days, the number of lower capital intensity software and technology-enabled services companies. It's those platform companies that have the greatest ability to look internet-like, if you will, and open up the pools of capital. And it really does feel, I think we're all going to look back and say 2017 is a really interesting period. We are hitting these tipping points where there's an awareness around the digitization of energy, the sort of 3D going, digital, distributed, and decarbonized. We are moving into an awareness around that. The capital's aware of that, and we've got lower capital intensity business models that are able to embrace that. And so that, combined with credit, we're in a really interesting time, low cost of capital, and a lot of exciting businesses. Now the challenge here is to get into the room next year or at the next summit, really trying to bring some of the institutional capital in alongside the corporate capital, so that and getting the pricing right, because often the corporate capital is coming in and pricing slightly in a more strategic nature, which can be good for companies. We've certainly in our business helped our clients take advantage of that. But you do need to make sure that if you've taken, let's say, high value corporate capital, that you can blend in institutional capital that might price on a different basis, so that companies can continue to grow their capital structure. And this is a big challenge, and this is the next step as the market moves from A round companies to B and C and D round companies. And it's exciting. I think we're on track, but we're going to have a few more conferences of yours with more of that capital in the room, I hope. I'm sure.
Okay. I actually want to thank you for being part of this panel and for joining Ecosummit, and you are most welcome to spread the word, okay? Bring in the investors that you think are still missing here. Okay, thank you very much. A big round of applause for the panel. Thank you.